Welcome to Drill Down Earnings. We have quarterly results out, the latest earnings from Analog Devices. This is the business story about one stock on the move. I'm Cory Johnson, Chief Market Strategist for Epistrophy Capital Research. Look at the 50 most important companies in technology, and Analog Devices, ADI, is one of the probably 6 largest semiconductor companies in the world. These results tell us a lot about a few industries, about automotive, about industrial, and communications and other stuff. So let's talk about all that. So second quarter fiscal year 2025 revenues of $2.6 billion, better than Wall Street's expectations, certainly better than what my model was looking for, as well as $1.14 in earnings, and yet in earnings per share. And yet the stock was down quite a bit in trading after these results came out. So why? Why do the company beats? The guidance is really strong, and yet the stock was down. So let's dig into it a little bit. So they are clearly in a rebound. Their revenue decline bottomed about a year and a half ago. 22% revenue growth, super strong. They raised numbers for next year, really showing what's possible with this business, that things are really growing, and margins turning around as well. Operating margins up to 26%. They had been as low as, high teens only a little more than a year ago. When you think of this business, so communications, surely important, and the communications revenue was up a lot. It was up 32% on a year-over-year basis. It was 12% of revenues. Industrial dominates, but communications important here because AI build-outs and growing demand for power and optical products. We talk about optical a lot in this podcast, and those analog device chips are going into those optical products, optical control products, into power products, and yes, into AI build-outs, as well as automotive test equipment. That's a huge, the ATE business, if you will, a big part of their business as well, now in hundreds of thousands of dollars and growing really strong for this company. But 76% of revenues at this company is coming from this business of selling to either automotive or industrial. So when you look at what these guys do, automotive industrial is so important, and both are doing very well. Now industrial, 44% of revenue, grew at 8% sequentially, up on a year-over-year basis, up 17%. So very strong for these guys. But and they said it was across all sectors in automation, aerospace, defense, and testing as well. But the real big change here, was in automotive. The automotive business for this company was up 29% on a year-over-year basis. Now we know auto sales went up 29%, but that was really what was driving this business. Why? More chips in the same amount of cars. So electrical vehicles, EVs, a lot more chips. Advanced driver assistance systems, ADAS, also seeing really increased content of silicon. But there also was a tariff-related effect, which is to say the automotive companies rushed to get as many chips on their shelves as they could get in this quarter. And that might be the secret to why the stock is down. The guidance was strong, the commentary was strong, the quarter was strong, and yet the stock sold off. And I think it might be because there's some concern that these great results might be one-time in nature, even though the company said that was not the case. In fact, if you look at the automotive pickup, no pun there, there's no pickup truck puns. We don't do pickup truck puns. We're better than that. You're better than that. Nonetheless, we see the pickup in automotive kind of lifting all ships. Another mixed metaphor as it relates to Analog Devices. Now I mentioned the stock selling off 5%, and that's after declining. Now it's down 12% for the year with the S&P up 10%. That's a really bad comparison for this company. It's really doing quite well. And inventory concerns are easing for this company, which has been a concern. Inventory at 135 days, as well as inventories up just 2% as their business is picking up a lot more. Now, 135 days seems to me like a lot, especially when the company 3 years ago was, I guess it was post-COVID, but in 2022, you're looking at less than 100 days of inventory. And CEO Vincent Roche was asked about that. What kind of inventory is right, particularly when it relates to industrial? Are customers stacking their shelves of stuff they're not going to need to reorder for a long time? What does it all mean? What's the inventory level, and does it feel right?
We're in a period now where we've got cyclical tailwinds. We've kept the channel very, very lean. We've been under shipping industrial significantly, actually. I think more so than any other market over the past 2 years. My sense is we're getting back to a more kind of a normalized convergence between demand and supply in that area. We're still keeping overall inventory, particularly in the channel, we're keeping it very, very lean, putting more inventory on our balance sheet to be ready for the upside.
So while investors are looking at some downside in Analog Devices, the CEO is looking for some upside in their business. It could be an interesting one to watch here. What's the big takeaway? What's the one number that tells us a whole lot? Well, I've got that. Analog Devices Q2 2025 earnings. The one number that tells you a whole lot is not the 22% revenue growth, although certainly we've seen a swing in this business from shrinking to growing, and that's going to continue according to the company. Not the $2.64 billion in revenue, growing really nicely, as I mentioned, 22% year over year. But the one number that tells you a whole lot is $849,505,000 worth of revenue in this quarter going to the automotive business, really picking up this company in a fantastic quarter with customers ordering ahead of tariffs, maybe worrying Wall Street, but maybe giving some consolation to worried manufacturers of automobiles. All right, thanks for checking out Drill Down Earnings. I'm Cory Johnson.